Hello and welcome to the Friday Market Update. Well, is 2026 going to be better than 2025 for real estate? Short answer, yes. Long answer, probably not by much, but enough to actually matter. But let's start this week with mortgage rates. What happened this week according to Mortgage News Daily? 30-year fixed rate loan for a prime borrower is sitting right around 6.24%. It's essentially unchanged from last week. But let's also talk about the jobs and inflation data that came out this week. The most recent ADP jobs report, which has been the primary report because the BLS, Bureau of Labor Statistics report, has been on ice because of the government shutdown. Well, the ADP report showed negative job growth of 32,000 for the month of November. 32,000 less jobs over that month, and that makes 4 straight months of weak or negative job numbers. That's a third of the year. So we also finally got the Fed's favorite inflation report after the government shut down, and that's the PCE, personal consumption expenditure. And that report came in as expected with a slight increase in overall inflation at 2.9%, but a decrease, which was great, in the more important core inflation at 2.8%. So they're still above the Fed's target of 2%. And we probably won't see any significant declines until next year's February and March figures are released based on how inflation is calculated on a rolling 12-month basis. So hitting expectations this month, big. That's good. It's not going to rile the markets, and we pretty much are on this steady path downward. The Fed focuses really heavily on these two things, jobs and inflation. And with both of those showing signs of cooling, another Fed rate cut is absolutely back on the table and in play at next week's Fed meeting. So the Vegas odds right now for a Fed cut next week, about 90%. Last week, it was less than 50%. So we'll gladly take it. And I think it'll be a good thing if they reduce the Fed funds rate. It helps so many people, credit cards. It will eventually lead to lower mortgage rates. It'll actually help the Fed pay their bills as well. So now remember, when the Fed cuts rates, it doesn't always mean that the mortgage rates will follow on that same day or follow in that same path immediately. Mortgage rates react to how Wall Street thinks the economy will respond after the cut. So it can be a bit of a bumpy ride. So the good news is that long term, though, Fed cuts do help mortgage rates trend lower. And I want to say at the beginning of last year, we peaked at 7.26%. We're down over 1% at that 6.24% level right now. So now back to the big question I asked earlier. Will 2026 be better than 2025 for real estate? So looking at the experts and what they're saying, they say only slightly. Here's what the general outlook looks like. They're saying more inventory will come to the market, which will increase transaction volume, and that should be higher than the last 3 years, but still below the pre-2020 levels. So home values are expected to rise somewhere between 1.5% and 2%. That's what the experts are saying. Mortgage rates, they believe, will shift lower, but probably not fall off a cliff. Most of them are kind of saying they're hovering around 6%. But what do I think? This is what I think. I believe we're going to see a very active market starting in January. The government shutdown created hesitation and uncertainty. I have borrowers fearful about jumping into the market because they think the job market isn't good. They think people are going to lose jobs. It's not that case. If you have a stable employment, this is the time to buy. I also believe the job market is weaker than what people realize, and inflation continues to cool. And we'll see that cooling even more, I believe, in the February-March time period. So if those two things hold, I think we're going to see interest rates dip into the high fives sometime in February. Now, that creates a psychological shift for buyers. So once buyers start hearing about 5% rates, again, in the media, because the media will start talking about it, the fence sitters are going to wake up. They're going to go, oh, man, the rates came down. The rates came down. They've been coming down. Now, affordability will not suddenly become easy, but there is a lot of pent-up demand. So think about this, and I've talked about this a lot. The median age of a first-time home buyer now in 2025 is 40 years old. Do you think they want to get into the game? Absolutely, they want to get into the game. And right now, seller incentives like closing costs, credits, and buy down, temporary rate buy downs are the secret weapon helping buyers make it work right now. So we also can't ignore the tax refund factor that's heading into 2026. With the tax law that was passed this year, many changes, many first-time buyers are going to receive larger refunds. Some will receive a lot more than others, but it can help them either pay off debt to qualify or save for a down payment. So for a lot of renters, that refund can become the missing piece to their down payment or closing costs. And for first time in years, refunds could actually help people move forward instead of just playing catch up. So now zoom out for a second. We just lived through 3 straight years of the lowest transaction volume in the last 30 years, hovering right around 4 million transactions per year nationally. That's about 1 million below norm. We are short nearly 3 million home sales compared to those normal levels. That frees locked out first-time buyers and move-up buyers alike. And so here's the real risk for first-time buyers. If prices soften a little bit and they come down a little bit and rates drop a little bit, well, guess what happens? Values will start to be pushed up again because the rates come down and the seller incentives will start to disappear. They have not disappeared yet. They're not going to disappear, I don't think, until after the Super Bowl. So when that happens, the door starts to get closed a little bit more and a little bit more, and affordability, comes back into play, but you're going to pay more for the house. So right now, this is a buyer's market, especially during the holidays and into January. Buyers should buy in a buyer's market. That's why it's called a buyer's market. And I know it feels scary. I know the fear is real. I hear it every day. But that's exactly why the education, you putting this information out there, educating them, getting them a smart game plan, letting them know what they can get from the sellers, instead of trying to time the best time to get into the market, it's time in the market. They're going to be having that house 7 to 10 years. So this is a time for your buyers to, in my opinion, suck it up. Be the buffalo and run into the storm. Be through that storm now, because trust me when I say, this will be a smaller storm in the buyer's market than when it shifts back to a seller's market. Because if it shifts back to the seller's market, guess what? The incentives go away, values go up, and buyers are going to regret, again, not jumping in. So that's my take on this. What's yours? I'd love to hear from you. This is Gaylord out. Hope you have a great weekend. We'll talk to you soon. Bye-bye.